NACA loans take a while. They're very strict. I'd say, man, just for personal experience, it's probably one of the most frustrating loans I've ever seen my clients go through, especially as a first-time home buyer. The program is so good for the borrower, but the journey is so frustrating for the buyer too because they're overwhelmed. So I'm interested in seeing this with you, Lisa.
I'm excited. I don't even know what it is, guys.
Alright. You don't need credit to buy a house. Let's just listen to the video.
Ooh.
Okay?
You actually do not even need a credit score in order to get a house. And I say that with utmost confidence because I've done it and thousands of people have done it. It's called a no score loan through manual underwriting.
What is the no score loan, Lisa?
no
I've
score-
never heard of that before.
They do exist, guys. They do exist. Here's the thing with the no score. That means you have no score. If you have not great credit, it's not like they're not going to give you a loan. They're going to give you a loan if you had no credit at all. So for those of you who are like, oh, okay, well, my credit's bad. Why don't I just go with the no credit and then they won't count it? Not every lender does that. It is a risk for them to do that. And that actually is per lender. So if the lender's going to keep their loan, they're not selling it to Fannie Mae and Freddie Mac, okay? They're going to hold on to it and everything. They may have products that can help with that. And again, no score really means no scores.
So if you have bad credit, it's considered a score.
Correct. Yeah, and no score doesn't mean that, okay, well, I don't have a score at all. It's more of like, okay, they're going to look at your utility bills, your rental history. So if you don't have that, you're living with mom and dad and everything like that, it may not always fly. This is a per lender type of thing. This is not a Fannie Mae Freddie Mac guideline. If, let's just say, for instance, they want a certain amount of clientele that has that, and keep in mind, anything that's a little bit different than the norm, the interest rate is going to be typically higher because it's a higher risk.
Yeah, this makes perfect sense. This is like a loan for like my mom. She doesn't have a credit card. She doesn't have a car loan. She uses cash for everything. But I feel like this is just me speculating because I don't know too much about this industry, about that. I'm assuming these type of loans are only utilized during like a slow market. So a buyer's market?
Yeah, it's funny because like probably about 5 years ago, there was another client that came to me and they had a tough situation. And I knew one of my friends from another lender was advertising this. So that's how I found out. I found out because they shared with me. I was like, oh, these are the stipulations. It's not as easy that it goes. We don't have that in our department. Just again, you know, we've been around for quite some time and everything like that. And we don't do those type of risks.
Yeah, I was very curious about this. That's why I was like, oh, I can't wait to show Lisa this. You know, like Mick is saying what class of lender would be able to give these loans out, where we could find that. Like, who would typically have these type of loans?
One of my buddies who actually used to work at a lending institution that advertised that. They haven't advertised it in a really, really long time. I don't know if they even have it anymore. So I'm going to look it up right now.
I feel like it's also kind of like renovation loans. Sometimes you hear these gurus talk about it, about finding a home that needs to be worked on. Just get a renovation loan, 2 or 3K loan. That's what it's called. 2 or 3K loans. I feel like it's mainly used during a buyer's market because right now in the seller's market where homes are going quick like that, remember, a seller still has to accept that loan because it normally takes months to close versus if they have over 20 offers like what we're seeing right now in this market, and other offers are not 2 or 3K loan where they could close in 20 days or less. They're gonna probably choose a 20 days or less offer versus yours that's gonna take a couple months, and contractors have to be approved by the banks. I feel like those type of loans, including this one, are meant more for a buyer's market where it takes 3 to 6 months on average to close. So it's already taking that long. Why not entertain that type of loan? Just my 2 cents. Did you find it?
I did. I mean, I found it on LendingTree, and LendingTree is kind of like almost like the Google for if you want to find anything on lending and whatnot. So get a cosigner. One of the things that says the 4 steps that you can get a no credit score loan. Before I go into this, let me go into what you're saying about the 2 or 3K loans. I've done 2 or 3K loans before. I've yet to ever do one that actually accepted a no credit score, by the way. Now, the other no credit scores is private money and hard money. They used to not require that, but in a very volatile market like it is right now, most of my hard money and private lenders are requiring it still. And those interest rates right now is around 12 to 15% right now. So if you want to go that route, absolutely.
And they're interest only, and you gotta pay back in 2 to 3 years.
There's a balloon payment. What that means is it's interest only. And in 2-3 years, if you can't pay that back, they will start the foreclosure process. And you have to pay that back in full. So for those of you who are thinking this is a great idea, you're buying a $500,000. If you're not having a way to get that $500,000 within 2 to 3 years, I mean, like refinancing it back, increasing your credit score to be able to do that, increasing your income to be able to do that, then it is tremendously risky. So here's what it's showing on LendingTree. Get a cosigner. Whether you have poor credit or no credit at all, adding a credit-worthy cosigning to your mortgage loan can be one way to improve your approval odds. It can improve your odds as far as adding more income to your debt-to-income ratio. But typically, lenders who look at credit will look at the average credit of the person that has the lower of the two. So that's not going to help you on credit-wise. Have a large down payment. Yes. So if you have a larger down payment, your debt-to-income ratio decreases a little bit, and that's going to help you because your monthly payment is going to be a little bit lower. But it has nothing to do with the credit portion. So I'm not sure why they said this is the 4 steps to having a no credit. Go through a manual underwriting process. What a manual underwriting process is, when you have a situation that's a little bit outside of the norm, the underwriter will manually underwrite this instead of going to all of the regular channels of the automated system. We have an automated desktop underwriting system that will determine whether or not you qualify based on all of your credit, based on all of the criteria that we punch into the system. A lot of times you're going to have a situation where you're kind of out of the norm. So the underwriter manually will determine, hey, your credit's not all there. However, do you have other compensating factors? Are you putting like 40% down? Are you, in a industry that is growing? Is the only reason why you had a tough situation on your credit is because of a medical situation? I had a client a few years back that unfortunately husband had a heart attack, and he was in the hospital for quite some time, and a lot of his income was dependent on his overtime income. Now his regular income, because he was getting disability income, was able to be counted, but we couldn't count any of his other overtime income, and therefore it really hurt his chances of getting home at that time. But when we convert it into a manual underwriting, they're looking at it and they're saying, okay, even though your credit got hurt because he couldn't pay a lot of his bills because of his income decreasing, the underwriter was like, oh, this was the only reason why his situation happened the way that it happened. And he was only not able to pay his bills during the time that he was hospitalized, during the time of his recovery period. And they deemed that, yeah, he's completely fine, and we were able to get that loan for them, and that was a great situation. So that's what manual underwriting is. I suppose if lenders are doing this type of loan, they will look at the compensating factors when you don't have a credit score. They're going to look at, okay, well, what type of job do you have? Is it self-employed? Is it a company that you just opened 2 years ago and it's in an industry that is kind of a little bit volatile?
Yeah, because I hear people getting loans through bank statement loans, and let me tell you, people, a lot of time those are the loans that are like what, subprime, right?
I wouldn't call them subprime. I see where you're getting at, Chia, because it's like, hey, how do you not do your due diligence? Yes and no. Those types of loans, you still have to put a minimum of 20% down. Then on top of that, you do also have to have reserves. Depending on the lender, it could be anywhere from 6 to 18 months worth of reserves.
Yeah, they've changed their guidelines on that a lot.
Right. The interest rate is actually higher as well. Those types of loans are great for investors whose debt to income ratio is typically too high because they have other properties, something of the sort, or they're self-employed. The bank statement ones are typically geared for self-employed people, where if you're self-employed and you write off everything, which you should, right? Legally, you're in the rights to write off whatever that you're allowed to write off. But if your gross income is $500,000, but you're writing off everything and now you're all the way down to $20,000, they're not going to look at that $500,000 no matter how high that gross is. They're only going to look at that $20,000 because you stated to Uncle Sam that you only made $20,000. Well, then if that's what you state to Uncle Sam, that's what the bank has to go by. So the bank statement loans is actually a really good one for self-employed people who are like, okay, well, I prefer not to pay Uncle Sam $100,000 of the $500,000 that I paid.
You guys didn't hear from us. Pay Uncle Sam, okay? Don't get locked up.
Instead of paying that, they'd rather pay the higher interest rate because at the end of the day, the math makes more sense for them to pay a few $100s a month than for them to put in $100,000 to pay off Uncle Sam just so that we can get that income to get higher. So every loan has its uniqueness. There's a reason for that. This one, the no credit one, we don't do.
Read the fine print before you actually utilize this loan. If you can find a lender that's giving it out, that's what I recommend. But let's finish watching the video and then we'll read some of the comments from the video.
And so if you have 12 months of rental history, you've had a year of cell phone bills and insurance bills, you can use that, and real people will actually look at your financial situation to approve you for a mortgage.
Exactly what you said.
Right. So when he says real people, the real people that own this lending institution.
Yeah, that's what they meant. Oh yeah, this person mentioned NACA can also get you a mortgage by using your income, and your credit score is not used during the loan approval process. I've helped somebody with NACA before. I'll tell you guys this, if you guys are using NACA is a longer process, especially in a very competitive market like we're seeing right now in Sacramento, California, because NACA, they're very strict on their approvals. They require a approved inspector to inspect the house, and then everything that you do, you have to upload it to the NACA portal, and then the agent that's helping you buy the home has to also be NACA approved. Okay, yes, I am NACA approved. You go through like a little small course and you sign up. NACA loans take a while. They're very strict. I'd say, man, just for personal experience, it's probably one of the most frustrating loans I've ever seen my clients go through, especially as a first-time home buyer. You're already very overwhelmed. Now you're going through this process of a NACA loan. The program is so good for the borrower, but the journey is so frustrating for the buyer too, because they're overwhelmed. Not only that, you have like one person, a middleman, that you're always keeping in contact with, and in California there's only one person handling thousands of clients in Northern California, and man, it is sometimes so difficult to get that person to respond back in a timely manner. And imagine in a market like this, to where you have contingencies, time is of the essence, you might end up getting served a notice to perform before you even do your inspections or anything like that, because they just take a while, so you really have to be lucky, and you really gotta find a seller that's willing to really be accommodating and understand that it is a NACA program. So generally for a NACA program, I'd say instead of it being a 30 to 45 day escrow, make it a 60-day escrow.
60 to sometimes even 90, and sometimes even longer, Tia. So I used to work for a company. We were NACA approved as well. I looked at the guidelines. The debt to income ratio is much lower. Like Chia said, it is a lot more strict income requirements and whatnot. And it just was not worth it for me to continue to be licensed for the NACA program. And this is probably the reason why there's only one loan officer. I've had so many clients who were so frustrated with the NACA program, and I showed them a different way to do this. Hey, let's tweak this a little bit. Let's work on your credit a little bit more. Let's do this a little bit more so that you can actually get a house, right? And Chia's right. NACA is actually a really good loan, but the process is so excruciatingly painful for many people that it actually comes out to be better if they just go to a regular FHA program and work their way up on that.
Yeah, and remember, NACA, nothing against NACA, they're a great program for buyers, first-time home buyers. I feel like it's probably more preferred in a buyer's market where it takes a longer time frame to close on a home already, so sellers are already kind of conditioned for that. Right now, where homes are being gone in 20 days, 7 days and all that, sellers probably gonna look at it and be like, oh, I got more options than choosing from a NACA. Unfortunately, that's just the nature of the beast right now. So be aware of that, okay? NACA is great. It's just not for everyone, and not a lot of sellers will entertain it, especially in this market that we see right now.
Absolutely, because the seller's also looking to buy another property. So if they don't know whether or not you're going to be able to close in the time frame that they need in order for them to secure the loan on the other side, then it's harder for them as well. It's not them being discriminative. It's them trying to protect their own interests too.
Yep, so you gotta look at it from both ways. I'm a mortgage underwriter. A manual underwrite requires only through FHA, but you have to find a lender that does manual underwriting. It is not that easy. I worked a lot for companies that don't do those loans because there are not a lot of investors on the secondary market that will buy those loans. So we should have stated what lenders do those loans. So he should have, which is true.
Correct. And that is the reason why many lenders do not do this no credit, because there's not a lot of investors that will buy this, and it's just going to sit there.
All right, y'all. Thanks for all the comments, and don't forget to like, subscribe if you haven't already to the channel, and then share this video as well. Thank you, Chi fans. You guys take care. See you guys next time.